and I just wanted to speak today about, I know everybody here is going into businesses and trying to decide what type of business entity would be best for them. So I figured we could cover the different types of business entities, the differences between them, and the similarities. So maybe to help you better decide which type of business entity is best for you and your business. Okay, so let's just get started. Objective: to identify the differences and similarities between the most common business types in order to help you decide what is right for you. So if anybody has any questions during the presentation, you can type them in the chat, or you can raise your hand and let me know and I can answer them. So these, what are the most common types of business entities, right? Sole proprietorship, which is one person owns the company and runs everything. Partnership is two or more people going to an agreement. Limited liability corporation, C corporation, and S corporation. And we're going to speak a little about each of them and what they each is and what their taxes and everything. Okay, and the reporting and the differences. So first one we're going to cover is sole proprietorship, which is the easiest one. Is a company owned by a single individual, a sole proprietor. This is the easiest to form out of all the corporates, all the companies. No legal restrictions to file. You just basically, you can start doing your business and reporting it on your taxes. You can register your company under your name, report everything under your own income tax, and go. The owner has complete control of the business. It's not taxed at the company level. It is taxed on your own income tax level. It's considered this is what is considered a pass-through account. So the income is passed through to the owner's individual income tax return and is reported on your income tax return. There's no limitation on legal liability. On the other hand, that's the one point, like any problems, if you have issues with legal problems, that can affect you and it can affect your personal life because there's no difference between you and the company. The company is yours. So that's the only part about this, that you can, like, for example, get sued and they could go after your own personal assets if you have issues with like a customer or something like that, or an employee. Owner is responsibly liable for any debts or legal claims against the company, and then creditors can take the personal assets of the owner if business debts exceed the owner's investment. At the same time, it is your company. All the money that you make is yours, and you don't have to share it with anybody except for obviously the government for taxes. You have another thing with this is you also have a limited ability to raise capital, since it's only you and whatever loans or money you on your own can raise. It's limited to what the owner can provide and personal resources through borrowing. So it's good, but you also have to prepare. Like, these points are not necessarily negative things. It's just things that if you are a sole proprietorship, that you have to be careful and you need to prepare for such things. Maybe like getting a liability insurance, so you're not liable for 100% of debts, or like, somebody takes you to court or whatever, you have a liability insurance can cover you, things like this. So it's good to be aware of these things, not for a negative purpose, but for you to find a way how to prepare for it in case it does happen in the future. Let's see. Let me see if I can start. How do I start this? Oh. Okay, here we go. The second business that we have is what is called a partnership. And a partnership is an association of two or more persons, or it doesn't have to be persons, could be, you could partner with a company too, who own and manage a company for profit. It requires an agreement between these two people to organize partnership agreements to organize. So this is called a partnership agreement or articles of partnership. One thing that you do not ever want to do is go into a partnership without a partnership agreement, because anything can happen. It doesn't matter who it is or how much you trust them. You must have a partnership agreement. It's very, very important. Some things about a partnership: participation in income, net income, and net losses are distributed among the partners according to their partnership agreements. So it all depends how you decide. If they're 50-50 partners, 60-40, depends. You make up your own agreement with you and your partner. If an agreement does not provide distribution, then income and losses are divided equally. This also is also a pass-through account. It's not taxable at a company level. Company's income or loss is passed through to the partner's individual income tax returns. However, a partnership must still report revenues, expenses, income, or loss annual to the IRS. So they basically just file a report. If I was like a tax, it's kind of like an income tax, but it's really just reporting your income or losses, but you will not pay it. It will just be like a zero, like a schedule on your income tax and your personal income tax. And then you would pay the taxes on your income tax. Anybody have any questions about partnerships or sole proprietorship so far? No? Okay. A little bit more about partnerships. There's no limitation on legal liability. Same as the sole proprietorship. Partners are personally liable for any debts or claims against the company. Creditors can take personal assets of the partners if business debt exceeds the owner's investment. So now since this is a partnership, and it's very much like something similar like a marriage. If one owner gets into debt, both owners are in debt. So if one partner gets an agreement for the company, you're both in that agreement. So they could go after, if your partner makes bad decisions, that can affect you. And if your partner, just like if they make good decisions, it can affect you. So you also want to pick a good partner that's also responsible and reliable, because if your partner is overspending on getting you into a lot of debt, they can come not only after their assets, but also yours too, because whatever agreements they sign for the partnership, it affects you both. This is a mutual agency, meaning each partner is an agent of the partnership and may act on behalf of the entire partnership. Liabilities created by one partner becomes liabilities to all partners. Co-ownership of partnership property. Property is invested in a partnership by a partner, becomes the joint property of all partners. So whatever you invest into the partnership becomes property of all partners. So any questions about that? Okay, so we can continue. These are the type of entities that can be taxed as a partnership. They are typically distinguished based on the types of business permitted to be conducted by the entity, the extent to which partners may participate in management, and the extent to which the partners are personally liable. So basically when there's a partnership, if you're liable, the income is divided up between the partners depending on what percentage partner you are, and each one will report it on their income taxes. These are some types of partnerships right here. A general partnership. A general partnership, two or more partners who are general partners. And what that means is that they both can participate in the management of the entity. There are no limited partners. So everyone participates. Everyone is an active partner, basically. Creditors of general partnerships can collect from both the partnership's assets and the personal assets of the owner of the partners. So obviously, if you're in a partner, go into a partnership together with somebody and you have more money than your partner, it's more likely that creditors will come after you over your partner. So that's also another thing to consider. A general partnership can be subject to a malpractice judgment brought against the practice. General partnerships are often used for both operating activities, example, product manufacturer sales and corporate joint ventures. So this is what, I'm not saying this to make it seem negative about partnerships. It's just to prepare you if you are going into a partnership with somebody, that's what partnership agreement will do. It will say you can put, stipulate in your agreement what you're liable for and what you're not liable for. So there's a limited partnership. A limited partnership is a partnership with one general partner and one more limited partners. So a limited partner will probably be somebody who is not involved in running the business, but they invest in the business, so they get a return on income, so on profits. So that's usually a limited partners. Then limited partners are not responsible for anything in the business. That they got no say in the managing. So has no limited partner has no management authority and cannot generally bind the partnership. They cannot sign anything for the partnership. They can get into any contracts for the partnership. The general partner retains all the management authority. Limited partners are usually financial backers who participate in the proceeds. So they get the right to look at the reports and see how the company is doing and to make sure that they're getting what they should be getting, but they make no decisions at all for the partnership. Typically, only the general partners are personally liable to creditors, so not the limited partners. Each general partner is liable. If there's more than one, there should be a percentage of how, we in your agreement, you will state how percentage you're liable. Are you 50% liable, that person 50% liable, or whatever you choose. Limited liability partnership, which is called an LLP. This is treated similar to the previous one. A general partnership in most states. The primary difference between an LLP and a general partnership is that an LLP is not personally liable for any malpractice committed by other partners. So that's one way. If you do not want to be liable, you could, for issues with your other, you could be in a limited liability partnership where your partner can be a limited partner and you both have limited liabilities. And then there's what is called a limited liability limited partnership. And this is an extension of the limited partnership in which all partners, whether general or limited, are accorded limited liability. At this writing, about half of US states permit formations of LLPs or recognize LLPs formed in another state. So not all states recognize this. So you would have to check with your state. Existing limited partnerships can acquire LLP status by filing a proper request with the appropriate state jurisdiction. So moving on from partnerships. Any questions about partnerships? No? Okay. So we have a limited liability company or an LLC. A limited liability company combines the corporate benefit of a limited liability for the owners with the benefits of a partnership taxation. So it's a company but taxed at the partnership level, including single technically considered to be members. So the members are called members, not partners. They're generally permitted to participate in management of the entity. A properly structured multi-owner LLC is generally treated as a partnership for all federal tax purposes under the check the box rules. So this, when you file your taxes, it's a box you check to be taxed as a partnership. Almost all states permit capital intensive companies, non-professional service oriented business, and some professional service providing companies to operate as LLCs. And so this is a good option if you want to be a partner with somebody, but you don't want to be liable for that person's decisions. So it'll be the company, but not your personal, like they can't come, since it's a company, it's a pass-through company, they can't come after your personal assets. Choose the partnership taxation often provides tax advantages. So for this LLC, it sometimes provides tax advantages over C or S corp. It's subject to only a single level of taxation. Corporate income, however, it is taxed at the entity level and upon distribution to corporate owners as dividends. Partnership income. So this is a corporate normally is taxed at 2 levels, but LLC would not be taxed at 2 levels because it's considered a pass-through account. So you will only report it on your taxes. And the corporation will just report its earnings, not pay taxes. Partnerships income can be subject to high tax rates at the partner level, depending on what tax bracket the partners are in. But this tax will generally be lower than the combined layers of tax on a corporate income. So it still be higher depending on your tax brackets, but it won't be as high as if you were in a corporation, you're getting taxed double because the company will be getting taxed and then the members will be getting taxed on their dividends also. A little more about limited liabilities companies. It's a legal entity that provides limited liability to its owners. Owners of a small business often want to combine the limited liability of a corporation with the pass-through provisions of a partnership. S corporations provide some of these. So S corporation, which we're going to speak about a little later, is also very similar to this, but where it offers you the pass-through account and the benefits of not being liable for having limited liability. The limited liability company is a form of entity that goes further in combining partnership taxation with limited personal liability for all owners of the entity. The IRS will treat an LLC either as a corporation, a partnership, or part of the owner's tax as a disregard entity, depending on how many members are in the company. A little bit more, limited liabilities company, a domestic. So it's basically considered a domestic company. So it's a domestic company with 2 members classified as a partnership for federal income tax purpose unless it files this form A32 and it elects to be treated as a corporation. For income tax purposes, an LLC with only 1 member is treated as a disregarded. So since it's only 1 member, the company will just report the earnings, but the income tax will be paid at the owner's personal income tax. Is treated as a disregarded, what is called disregarded entity, separate from its owner, unless it files this form AA32 and elects to be treated as a corporation. However, purposes of employment tax and certain for purposes of employment tax, a certain excise tax, an LLC with only 1 member is still considered a separate entity. So it's only for federal income tax purposes. Owners of an LLC are called members. Most states do not restrict ownership. Some members may include individuals, corporations, and other LLCs, and foreign entities. There is no maximum number of members. Most states also permit single member LLCs, those having only 1 owner. A few types of businesses generally cannot be LLCs, such as banks, insurance companies. So you have to check your state's requirements and the federal tax regulation and for further information for your specific company to see if it can or cannot be formed as an LLC. There are special rules for foreign LLCs. A little bit more, members have limited liability. So once again, even if they are active in the company. So not like partnerships, right? The only limited partners have limited liability. Members' personal assets are legally protected against creditors, claims made against the LLC, and claims made against the LLC. Only the members' investment in the company are subject to claims by creditors. Income passes through the LLC and is taxed on the individual member's tax return. Limited partners cannot participate in the management of the partnership. All owners of an LLC have the legal right. All owners of an LLC have the legal right to participate in the entity's managers. So all the owners have legal. If you are a limited partner of the LLC, then because you can become a partner with an LLC or get into a partnership with an LLC. So if you will be like a limited partner, you can participate in management, but all owners of the LLC have the legit right to participate in the management of the LLC. Any questions about limited liability companies before we move on to C corporations? Yeah. Okay. C corporations, they are one of the oldest forms of business entity that exists. Corporations are usually the preferred legal entity for businesses that are or plan to be publicly traded. So if you are hoping to be publicly traded in the future, then this will be the type of entity for you. Because in accessing public markets or for investment capitals is not the only reason to choose a corporation, though. There are many other reasons that you would eventually, like we're just doing an overview right now, but you eventually sit down with your accountant and they will go over things like this in a lot more detail. In forming a corporation, prospective shareholders exchange money, property, or both for the corporation's capital stock. A corporation generally takes the same deductions as a sole proprietorship to figure its taxable income. A corporation can also take special deductions for federal income tax purposes. A C corporation is recognized as a separate tax entity, so it's completely separate from the owners. It's a separate entity with its own tax number, separate than your own social security number. A corporation conducts business, realizes net incomes or loss, pays taxes, and distribute profits to shareholders. So the owners are considered shareholders of a C corporation. The profit of a corporation is taxed to the corporation when it's earned, and then it is taxed again to the shareholders when distributed as dividends. This creates a double tax. The corporation does not get a tax deduction when it distributes dividends to shareholders. Shareholders cannot deduct any loss of the corporation. So the corporation deducts the loss, not the shareholders. Corporations that elect to pass corporate income, losses, deductions, and credits through to their shareholders for federal purposes, these are S corporations. So if you do choose to, choose to pass all this through the shareholders, then you can form an S corporation. So this is another way to have the benefits of a C corporation, but at the double taxation. Shareholders of an S corporation, they report the flow through income and losses on their personal taxes and are taxed at their individual income tax rates. This allows S corporations to avoid double taxation on the corporate income. S corporations are responsible for tax on certain built-in gains and passive income at the entity level. This type of entity, the S corporation, as opposed to a C corporation, provides many of the benefits of a partnership taxation. At the same time, it gives owners limited liability protection from creditors. So it's still a separate entity. It operates the same as a C corporation, except that you can pass through the incomes and losses to your personal account, to the shareholders' personal level. S corporation status is obtained through an election by a qualifying corporation with consent of as shareholders. So you have to qualify to be able to register as a S corporation. Once your company becomes too big, then you will have to move over to a C corporation. But for smaller corporations, is that you do not want to be taxed double, you can start off as S corporation. In once your company becomes very big, then you can switch over to a C corporation. Any questions on this? Okay. A little bit more about S corporations. An S corporation is treated as a corporation under state law. It is recognized as a separate legal entity, and it provides shareholders with the same liability protection afforded by C corporations. It is created through filing articles of incorporation. It issues stock and is governed as a corporation with directors, officers, and shareholders who function in the same manner as a C corp. For federal income tax purposes, however, taxation of S corporation resembles that of a partnerships. With partnerships, the income deductions and tax credits of an S corporation flow through to shareholders annually, regardless of whether corporations are made. Thus, income is taxed at the shareholders level and not at the corporate level. Payments to S shareholders by the corporation are distributed tax-free to the extent the distributed earnings are previously taxed. Further, certain corporate penalty taxes like accumulated earning tax and personal holding and company tax and the alternative minimum tax do not apply to an S corporation. Any questions on this? Seriously. Tax planning, right? When S corporation is advisable, right? So if you losses are anticipated, like if you're starting a business and you anticipate that you're going to have losses, if the answer is yes, then S election may be highly attractive because those losses can pass through to the shareholders. What are your tax brackets of the shareholders? If the shareholders are in a high individual's income tax bracket, then it may be better to avoid an S corp, right, status and have profits taxed to the corporation at lower rates of 15 to 25%. However, the income is still not in the owner's hands. When shareholders are in the lower individual income tax brackets, the pass-through of a corporate profit is attractive and reducing the combined income tax because the paramount consideration, right? In this case, S corporation will be an effective tax planning tool. However, not all that, although an S corporation usually escapes federal tax, it may not be immune from state, local imposed taxes on the corporation. So we're just talking about federal tax. It might still need to pay state and other local taxes, and or from several penalty taxes too. Any questions? Okay. A little bit more about this. Both individuals and C corporations are subject to the alternative minimum tax. Many of the tax preference and adjustment items are the same, but some apply to corporate taxpayers while others are limited to individuals. As corporations and partnerships have limited liability in the choice of a tax account, period. To take advantage of the structural benefits of LLC, combined with the taxation benefits of an S corp, you can establish your business entity as an LLC and then make the election to have it treated as an S corp by the IRS for income tax purposes. So that's another option too, that you can register as an LLC and tell the IRS when you go file your taxes to treat you as an S corporation. Any questions? Okay, moving on. Okay, choosing structure. Here's some things to consider. First of all, determine the number of owners. Evaluate your tax benefits and drawbacks. Evaluate liability issues. If your business has a high liability, right? If it's a high liability business, then you may want to consider a corporation or a limited liability company, which protect the owner's personal assets. If your business is a low liability one, then another business structure may be better for you. Determine the record keeping requirements. Also, and the IRS has very specific record keeping requirements depending on the type of entity, right? Our Internal Revenue Service requires corporations to maintain business records that are separate from personal ones. The state where these business operates also require corporations to file an annual report. Sole proprietorships and partnerships do not have to abide by these requirements. Generally, states require a limited liability company to have an operating agreement, which is a document that states the owner of the company and the management structure. So basically, just a document that states who manages the company, what's the company structure. Any other questions on this? No? If you don't understand anything that or something, or you have I need to explain something a little more, just let me know. I'll gladly stop and explain a little more. Oh, that's my last one. Oh, yes, here my references. I use the IRS website as also my own accounting textbooks. Thank you so much for being here today. I guess this went very fast. We had no questions.
Clarabelle, there's a hand raised.
Oh, hi. Yes. I may stop sharing.
Hi, Clarabelle. This is Mary speaking. How are you?
Oh, hi, Mary. How are you?
Good, thank you. I have a question. I went to sit down to determine which business entity. I sat down with my accountant.
You did, okay.
And so I thought it was going to be something different, but I don't have the knowledge, obviously, like you and my accountant. He came up, I mean, I have an S Corp, opened up an S Corp.
Okay.
But I thought it was going to be something like, for example, like if you're a therapist,
Mhm.
you offer private therapy sessions.
Okay.
What business are you opening if you're just a person offering services? Like, let's say for me, maybe it's the tutoring angle, but I do other things. Like, why did he choose an S Corp instead of something else? Because I would have like a small one-on-one, client by client basis. You know what I'm saying? My question.
It's just you, right? Like you don't have a partner, it's just you.
Correct.
Are you at a high income tax bracket? Maybe perhaps that's why.
I don't think that's the case.
I mean, maybe because I'm not sure.
Well, S Corp is working for me. It's been 3 years, but I would never know the difference.
Right. I think it's odd because you don't anticipate having any losses.
No.
And I think a LLC would have been good for you too. But S corporation and LLCs are very similar, so it's not really like a big difference between them, you know. So it might just be like your accountant's like personal preference.
Like, I didn't ask him, but he's an accountant. He's sitting there. He's his own boss. He, you know, it's his practice, and we're in his office. What kind of a business does he have?
Maybe he thinks that your company is gonna grow a lot, so that's why he chose the S corporation for you.
Yeah.
Like he sees like you eventually making a lot of money, since it is a company with, like, you don't have a lot of overhead, right?
No.
So he probably sees you growing a lot in the future. That's probably why he chose the S corporation for you.
Okay. I was just wondering, like, I didn't ask him this question, but
Because
if he-
like technically
he
you're
takes
already,
a client, right? If he makes an appointment, takes a client into his office,
Mhm.
what kind of business structure do you think he has?
Most service businesses are either like limited liability companies or S corporations. Yeah.
Okay, either
Mhm.
either or.
Mhm.
Okay. See, my friend had an LLC at the same time that I was looking into which type of business to file for.
Mhm.
And I didn't understand why she had the LLC, but she had a brick and mortar. So
Yeah.
and definitely overhead. So anyway, okay. I trust you guys and I trust my accountant. I
Yeah.
just didn't know I didn't understand why they knew to get the S corp as opposed to other entities.
And you
So,
have to also remember, because your accountant has all your books
Yep.
and everything, knows everything about your company specifically. And you should ask him, why did you choose this? Like, it's not that you don't trust him, but you have a right to ask him. He can explain it. Remember, the accountant works for you, so you can
yes.
sit there and ask him all the questions that you need, and go over your books with him and everything. Next time you meet with him, write down all your questions and be like, oh, what did we choose this, what this, and then ask him things like that, and he'll gladly answer it for you.
Hmm.
I think
Yeah.
like accountants, they really like it when their clients are like, a lot of people don't want to ask questions, but they actually really like it when their customers are like very involved in the business, because some people just, okay, the accountant will take care of it, but it's your business, you really need to be very involved in it. But I think
You're right.
S corporation is good for you because you're already incorporated, so in the future, if you do grow a lot, it have to become a C corporation. And like, let's say I don't know if you plan on opening offices, or is this going to be like an online therapy session?
I don't know. I don't know. At this point in time, it's online.
Okay.
I can do services in person, but
Mhm.
I don't have any regularity of it.
So like, if you plan on growing in the future, you just have to switch over from S corp to a C corp, but you already incorporated. Like, you keep the same
That-
tax number and everything. So maybe
Okay.
that's why.
That's why I wanted to just ask you. You said since you're already incorporated,
Right, yeah, because you already have a corporation, you have a S corporation. So
right?
you already have a tax IN number, right?
Yes, I have a tax ID. Hmm.
Yeah, so then with that, like, even you could use the same number in as a C corporation. You could just, like, if you grow a lot, you turn your company into a C corporation. It'll be
Okay.
easier to go from a S corporation to a C corporation than from like I said, a partnership to a C corporation. So maybe that's why he chose that for you.
Okay.
Mhm.
If there's another business, if I do business to business,
Mhm.
does it matter at all what type of a business I might be doing with? Like, I'll give you an example of what I'd
Mhm.
like. I'd like a certain business in a certain country to
Mhm.
hire me, and I would do English lessons with their employees,
Mhm.
just let's say 1 hour a day for this company.
Right. Right.
That's business to business, right?
Yes. Mhm.
Okay. Now, does
Yeah.
it matter? Does it matter on the other end what type of a business structure I'm entering a business agreement with or transaction or
No, it doesn't matter because it's just a customer, right? Or you're partnering
yeah,
with them.
it would be a customer, I suppose. Yeah.
Yeah, they end that. No, it doesn't matter.
Okay, so business to business doesn't matter what type it is.
Yeah,
Okay,
no.
thank you.
No, unless you're partnering with another business, then you could, there will be an LLC, an S corporation partnering with a partnership, entering into partnership. So you'll have like that double.
So I could enter, so with an S corp, I can enter a partnership.
Yeah, you could partner up with a company, but I don't think you could be like a general partner, but maybe like a limited partner.
Okay, I don't totally understand, but I'm sure I will eventually.
Yeah. But if you to consider something like that, you just speak to your accountant and they'll set it all up for you. All
Yeah,
right, this question's
you.
here. Let's see. Okay. 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 Okay, people just asking. Okay, any other questions? So, well, thank you so much. If you guys think of anything else, you can send an email. If you guys want to meet with me in person and have me look at your financials, I'll be more than happy to do it. Or if you want to meet and ask more questions, anything that you didn't think of today, you know, you can reach out to Kenya and she'll set up a meeting. Okay.
Great. Thank you, Clarabelle.
Okay.
I want to
thank
thank everyone for coming out, and I look forward to seeing you at the next webinar next week, Thursday. We're going to have a webinar on the great product photography. So if you're in that industry and want to learn more about how to, you know, get more business or how to get the best return in your business, join us next Thursday at 7. I'm going to put the link here in the chat so you guys can get registered. And I'll give you a few minutes before we end.